This is a game changer also. This is the tax rates for 2018. And so as you look at this, single, married, filing joint, married, filing separate, head of household, and the various income brackets. The income brackets in and of themselves didn't change much from 2017 to 2018. What changed is the percentage that is used to calculate your tax. So for a single person making $50,000, they're in a 22% tax bracket. Last year, it was a 25% tax bracket. So the dollar amounts haven't changed all that much, but the amount of tax percentage that you're being calculated on is changing. Capital gains rates. Interesting also, the rates haven't changed. There's some interesting things you can do with capital gains rates because you have a 0% rate. So a calculation that goes through this, that if you are underneath these levels here, technically, you could sell investment property, a stock, something that's generating a long-term capital gain. You could actually sell that at 0% tax. Now, obviously there's calculations that go through to make that happen, but if you're coming down to the end of the year and you're looking at your portfolio and looking at your income, there's a number in there, there's a sweet spot in there that you could figure out or have somebody, either your accountant or my accountant, help you figure out that there's a point in time where I could sell X number of dollars of stocks and pay 0 tax on it. It's going to make the planning side of things a little bit harder, but the planning side of things is going to be beneficial because it's going to allow you to play with your tax return to be the most beneficial to you as you're looking at your portfolio and deciding on what to do. Next thing, this big changes, standard deductions and personal exemptions. So a couple statistics to start. So in 2017, about 25% of tax returns filed in the United States had an itemized deduction schedule attached to it. With these new changes, they're predicting that that's going to go down to about 11%. And what they're doing is they have greatly expanded what your standard deduction is allowed to be. They've almost doubled, not quite doubled it, but almost doubled it. So a lot of people that had a married couple who had $18,000 of itemized deductions, in 2017 they would itemize, in 2018 they're not going to itemize anymore. But there's a caveat to that because personal exemptions have been eliminated. So used to, you'd get a personal exemption for you, your spouse if you have one, your kids, your dependents, you'd get an exemption for them. No longer, that exemption is completely gone. They've built it into that number is what they've tried to do. No personal exemptions though is playing games with other things, one of which is the child tax credit. No exemption, no child tax credit. So they expanded the child tax credit. Was $1,000, now it's gone to $2,000. People who have kids, this is a good thing because they've also added, used to when your kid was 17, they would drop off of your tax return for the child tax credit purposes. Now you can get a $500 tax credit for kids that are above 17. If you have kids in college, whatever the case may be. This also would qualify for if you claim a parent on your tax return. You can now get a $500 tax credit for your parent if you qualify to carry your parent as a dependent. The good thing with this is they have increased the income limitations in order to qualify for a child tax credit. $200,000 for single, $400,000 for married. So at that income level, people in 2017 were not getting the child tax credit. You were exempted, phased out of it. In 2018, you might be losing something. So people are going to say, I'm going to lose my itemized deductions. That's a bad thing. Well, it may or may not be. It all depends on how your tax return works because you also could be picking up something else in another spot. The crazy thing about this is that this is truly every single tax return is going to work differently in how these rules apply to your personal situation. You're going to be getting deductions that you didn't used to get. You're going to lose deductions that you used to get. In the end, and this is analysis that the Tax Institute has done, in the end, in general, most people will come out in a favorable position under these new tax laws. Now, there will be instances where somebody's going to not come out in a favorable position. But for the vast majority of people, they're going to come out in a favorable position looking 17 to 18 at their tax returns.